Most people are told that debt is a trap, something to be avoided at all cost.
The United States has hit a grim financial milestone. For the first time since World War II, our national debt is now larger than our entire annual economic output.
But in the world of high finance, debt isn't just a burden. It's the primary engine of the American economy.
This is America, and that is the US Treasury. Here, the national debt has exceeded GDP for the first time since World War II.
From a simple mortgage to a $1 billion treasury bond, there are 7 distinct levels to this game. Today, we are stripping away the politics to look at the cold, hard mechanics of US debt. We will track the journey from productive debt that creates wealth to the sovereign crisis that can dismantle a superpower. So what do you think? Is a US debt a catalyst for growth or a mathematical certainty of collapse?
I've been warning about this for 2 decades. America's national debt now exceeds the total annual output of our economy. Every hour, the debt grows by $180 million. That's $5 billion a day, and it's approaching $40 trillion.
Debt in the United States starts with the belief that some borrowing acts as a catalyst for growth. This is known as good debt or productive debt. It includes loans used to fund education, build infrastructure, or make investments that generate future income. For example, taking out a mortgage to buy a home in a growing market provides personal stability and pumps capital into the economy. Similarly, student loans might seem like a burden, but they often lead to higher earning potential, which boosts the country's overall economic productivity. Governments and corporations rely on this type of debt to stimulate development, betting that the long-term returns will outweigh the cost. The key is using debt to increase capacity and build wealth, ensuring that the borrowing is always aligned with growth and productivity. As borrowing becomes more sophisticated, organizations and investors use leverage to amplify their financial positions. In the market, this happens through complex tools like bonds and derivatives that allow institutions to magnify their exposure. For example, the US government issues treasury bonds, which are considered low risk. However, the broader financial markets often operate with high leverage. This can be a powerful accelerator for growth, but it is also a source of systemic vulnerability. We need to understand that leverage works both ways. It amplifies gains during good times, but it also magnifies losses during downturn. When markets are strong, leverage can lead to exponential wealth. When markets fall, that same leverage can trigger a financial crisis. The challenge is managing this delicate balance because excessive leverage can quickly turn beneficial debt into path toward instability. The federal debt begins to swell as the government borrows to fund deficit, often to stimulate the economy during recessions or to finance expensive social programs. This debt accumulation is driven by policy decisions made in response to economic conditions, but it also reflects the underlying market environment. For instance, in recent decades, the US has financed large deficit through issuance of treasury securities, attracting domestic and international investors seeking safe assets. The Federal Reserve's policies, such as quantitative easing, have also played a role by purchasing government debt to keep interest rates low. This stage reveals a complex interplay. Borrowing fuels short-term economic activity, but raises concerns about long-term sustainability. When debt levels become high relative to GDP, it signals increased risk, but it also reflects the market's confidence in the country's ability to meet its obligation. As debt grows, the cost of carrying it increases. paying interest becomes a major part of the government's budget. In the United States, interest payments on the national debt are a large and growing expense. These payments now account for about 6.5% of all federal spending, which takes money away from other vital priorities like infrastructure, education, and defense. When interest rates are low, the debt is manageable. However, if rates rise or the total debt increases, these costs can quickly spiral. This creates a dangerous feedback loop. Higher debt leads to higher interest payments, which often requires even more borrowing or deep spending cuts. This risks a downward spiral for the entire economy. Managing this balance requires a smart policy, market confidence, and difficult choices to keep the debt from becoming an impossible burden. See, how the market sees the safety of US debt is everything. Because the dollar is the world's primary reserve currency and the US economy is so massive that American debt has a unique advantage. However, this entire system depends on investor confidence. If investors begin to doubt that the country can manage its debts, interest rates will climb and it will become harder for the government to access capital. We see this happen during debt ceiling standoffs or periods of political stalemate. In those moments, investors may demand higher returns or start moving away from US bonds, which signals a major risk. This shift does not just make borrowing more expensive, it also threatens the stability of the dollar itself. To stay credible, the government must show disciplined spending and clear policies. This is the only way to keep the markets calm and preserve the country's ability to borrow when it needs to. The danger begins when debt grows so large that simply paying the interest eats up too much of the government's income. This leaves very little money for important things like infrastructure, schools, or social programs. This is known as the credit trap. It creates a situation where the government depends on borrowing just to pay the interest on its existing loans. In other words, new debt is being used to pay for old debt. For example, when a country's total debt is higher than everything its economy produces in a year, its financial health is under extreme strain. This situation destroys investor confidence and drives up interest rates, making borrowing even more expensive. The ultimate risk is a vicious cycle. More debt leads to higher cost, which leads to even more borrowing. Eventually, this can cause a total loss of confidence that threatens the stability of the entire economy. At the final stage, when debt becomes unsustainable, a country faces a sovereign debt crisis. This happens when leaders lose faith that the government can pay back its loans. To survive, the government is often forced to default on its debt or restructure it by renegotiating the terms with those it owns. History shows how painful this can be. Greece, for example, reached a point where its debt was so high that it required massive bailouts. These bailouts came with strict austerity measures, which are deep and forced cuts to government spending and public services. For the United States, this scenario is less likely because of its massive economy and the dollar's status as the world's primary currency. However, the risk remains if debt grows unchecked and political leaders lack the willpower to control deficits. The crisis of this scale causes total economic upheaval. Borrowing costs soar, people lose confidence in the currency, and the country can fall into a severe recession. Avoiding this outcome requires disciplined spending, structural reforms, and a clear plan for long-term financial health. When we look at the 7 levels of US debt, it becomes clear that debt isn't always a negative force. Instead, it is a tool that can stimulate growth and development if managed wisely. The real challenge is recognizing the tripping points. those moments when debt shifts from a strategic asset into a burdensome trap. Market dynamics are driven by investor perceptions, policy choices, and the resilience of the overall system. The broader lesson is that sustainable debt management requires a mix of disciplined spending and strategic investment. This ensures that borrowing remains a means of progress rather than a path to decline. Maintaining this delicate balance is crucial for long-term economic stability and prosperity. So at which level do you think the system breaks? In my view, the system begins to fracture at level 5, the power of perception. While the credit trap, which is level 6, is where the math fails, level 5 is where the psychology fails. Because the US dollar is a global reserve currency, the United States can carry much more debt than other nations, but only as long as the world believes it can. If investor confidence vanishes due to political gridlock or perceived instability, borrowing costs skyrocket instantly. At that point, the transition to the trap and crisis, which is level 6 and level 7, becomes almost inevitable. The system does not break when the money runs out. It breaks when the trust does. Take care of yourself.